Hey Jeff, Rob Zbart, Landmark Mortgage Planners. Just wanted to touch base. Sorry I didn't get this to you earlier. I was going to try to get it to you last night and then it got sidetracked, but just wanted to show you, and I think you understand this. I know we wanted to try to get together and just wanted to show you some of the strategies we're using for, sort of like more of a financial planning approach. But first and foremost for Evette is, eliminating that payment. We think that's going to be about $1,400 a month of the $1,950. But what I wanted to show you is, if you looked at the amortization schedule that I sent you, there is no line of credit, right? But if we modify this and we start to make voluntary payments, so they can make partial payments. So click on that, click on partial payments, and let's just say right away, of course, we know that they have $1,450 a month of payments to make for the next 28 and a half years. So let's just say that for now we just illustrate them making payments for 10 years. So we're going to do, let's see, $1,450 a month. Voluntary payments, so the future projections will show a little bit different now. Instead of that loan balance growing over time, it grows much less. And so many years later, as you can see, it keeps the balance down instead of, as the last graph showed, is up here. But what we're doing now is we're establishing, instead of having a zero line of credit, we're funding a line of credit that's growing at about 6%. So that at this point here, let's just say later in life, 85 years old, for instance, there's a $302,000 bucket of tax-free money sitting there. So of course at that point they can do whatever they'd like with it. For instance, we can illustrate them turning that into tax-free income stream. And so we would just go into line of credit conversion, and let's just say at 85 is when they want to start taking income. So start receiving payments in, we'll call that, was it 15 years? That might be wrong, but let's see what that does. So let's go to the amortization. Well, I'll go back to the future projections. Of course, all that's showing here is the growing line of credit at 87 years old is basically converted. So I should have put 13 years there, but just for illustrative purposes for you, just to show you how that affects the AM schedule. The zero balance and the line of credit now, after putting that $1,450 a month away, at 87 years old has $376,000. So let's just go back and we'll change that and say at 85 years old. So we'll go to year 13. We're going to convert it at year 13. And we'll calculate it. So now when we go to the AM schedule, it'll stop that $1,450 a month payment here at 86 years old. And now we've got $33,708 guaranteed income. Doesn't matter. There's no market performance like, IULs or sometimes different annuities to get the guaranteed payment. This is just a guarantee. It's irrelevant if the property value dropped to $300,000. They still receive this $33,708, or in the far right column, $2,809 per month tax free for life. So they don't have to turn that on. Of course, if at that point they have $358,000 and they just want to pull random amounts of money off that line of credit, there's no restrictions. They can take a $358,000 lump sum tax-free, and of course the balance here in this column in the line of credit would go to zero, and the loan balance would go up $350,000. So, just wanted to show that. Just another financial planning tool using the equity and the housing wealth wisely. So let me know what you think, and we'll talk to you soon. Thanks, Jeff. Bye.